Hello and welcome to today's webinar. My name is Sarah Burke and I'm the Marketing Director here at Tonneson & Company. Today we're going to take a closer look at some of the key changes impacting individuals and businesses with the passage of the new Tax Cuts and Jobs Act. I'd like to thank those of you who sent in questions in advance. We will be addressing some of your questions during the course of our presentation. Please note that audio has been muted for all attendees on today's webinar. If you'd like to ask a question, simply type your question into the Q&A box in your control panel. We'll save time at the end of our discussion to answer as many questions as possible. But if we don't get to your question, we'll follow up with you after the webinar. I'd like to start off with just a quick overview of Tonneson & Company. Tonneson & Company is a certified public accounting firm based in Wakefield, Massachusetts, with additional offices in Boston and in Columbia, Maryland. Over the last 43 years in business, we've built a strong reputation for providing trustworthy counsel to our clients. Our clients include privately held businesses, nonprofits, multifamily offices, and individuals. We offer our clients expertise in areas such as business tax, mergers and acquisitions, international tax, advisory, and assurance services. Next, I'd like to introduce our speakers for today. Rick Mastrocola is the President and CEO of Tonneson & Company, and he'll be moderating today's discussion. Amy Phelan is a tax shareholder who will be relating her insights on key provisions related to individuals and estate tax changes. And John Parker is also a tax shareholder. He'll be illuminating some of the key business tax implications of the tax reform bill. And with that, I'd like to turn things over to Rick. Rick?
Thank you, Sarah. Good afternoon. On December 22nd, 2017, President Trump signed into law the Tax Cuts and Jobs Act, which is effective for tax years beginning in 2018. This Tax Act is the largest overhaul of the Internal Revenue Code since the Tax Reform Act of 1986, which was signed into law by President Reagan over 30 years ago. Today, our plan is to provide you with an overview of some of the more widely applicable provisions for individuals, trusts, estates, and domestic corporations. We will not be discussing foreign corps, not-for-profit, or elected small business trusts. As always, if you have any questions, please reach out to your tax executive and here at Tonneson, and we'll be glad to respond to your questions. Thank you. Now I'd like to introduce Amy Phelan.
Thank you, Rick, and thank you everyone for joining us today. One of the biggest changes that has occurred with the Tax Cuts and Jobs Act is the change in rates and the rate bracket structure. In 2018, we will continue to have 7 brackets, but the rates applicable to each bracket have been reduced and the brackets were broadened for each applicable rate. As you can see on the slide, the new rates applicable in 2018 range from 10% to a top rate of 37%, versus the prior rate starting at 10% with the top rate at 39.6%.
Amy, we've got a number of questions regarding the marriage penalty. Could you please run through an example of that?
Sure. Let's take a look at another slide. Notice that taxpayers will not feel the sting of a marriage penalty until their combined adjusted gross income exceeds $400,000 if married filing jointly. Up until that 35% bracket, the brackets are exactly double when comparing single to married filing joint. For a simple example, assume 2 taxpayers have adjusted gross income of $500,000, each for a combined income of $1 million. If they remain single, their respective highest bracket would be 35%. If they decide to marry during that same year and choose to file married filing jointly, the combined income of $1 million bumps them into the highest tax bracket, now at 37%. As a reminder, if you are married at the end of the calendar year, you are required to file either married filing jointly or married filing separate. Typically, filing married filing separate is not tax efficient due to the compressed tax brackets. In our example above, income of $300,000 or more will bump a taxpayer choosing to file this way into the highest tax bracket of 37%. The tax treatment of capital gains and qualified dividends remains unchanged at 0%, 15%, and 20% for those taxpayers in the top brackets. The thresholds have changed, and we've included a slide of 2018 capital gains tax rates for your reference. In 2018, for married taxpayers with adjusted gross income in excess of $479,001, tax on capital gains and qualified dividends will be 20%. Short-term capital gains will continue to be taxed as ordinary income. The alternative minimum tax, or AMT, for individuals was not eliminated. However, exemption and income threshold phase-out amounts have been increased, which combined with some of the other changes to certain itemized deductions will bring a number of taxpayers out of AMT beginning in 2018.
Amy, could you give us an example of a tax planning opportunity that might benefit our clients as it relates to the change in alternative minimum tax?
Absolutely. One that comes to mind would be for those taxpayers that may have incentive stock options that they should take a look at and consider exercising. As a reminder, when a taxpayer exercises ISOs, there is not an ordinary income tax, but instead the spread between the exercise price and the fair value is an add back for alternative minimum tax purposes. With the new increased exemptions and income phase-out amounts, the possibility of shielding such income from alternative minimum tax becomes more feasible. Another change worth mentioning is the rules surrounding the Kiddie tax. Prior to the change, children were taxed on unearned income at the parent's marginal rate. We often had to extend simple children returns because we needed to wait for the parents to be complete. With the new law, children will be taxed on their earned income at their marginal rate and unearned income at the new trust rates. I also want to quickly mention the change to the child tax credit. Many of our clients were phased out in the past due to phase-out thresholds amounts beginning at $110,000. The new law increased phase-out limits to $400,000 for joint filers and $200,000 for others, and the credit is increased from $1,000 per child to $2,000. Now I'm going to talk a little bit about the changes to the standard deduction and personal exemptions. The basic standard deduction amounts have been increased significantly. We have provided a slide with the changes for your reference. The additional standard deduction for people who have reached age 65 or who are blind is retained. These amounts will be added, if applicable, to the standard deduction as have been in the past. Such increases will help mitigate the sting many taxpayers will feel with the new rules surrounding itemized deductions, which we will be discussing in a few minutes. The deduction for personal dependency exemptions is repealed. Many of our clients may already have been subject to phase-outs of these exemptions, so they may not feel much of an impact here. However, it is important to note that we still need to identify qualifying dependents, children, and others for purposes of other deductions or credits. Now we are going to talk about some of the significant changes we will see surrounding itemized deductions. First off, the overall limitation on itemized deductions has been repealed. The P's limitation, as it was referred to, reduced the amount of itemized deductions allowed to be taken by certain individuals with adjusted gross income in excess of applicable thresholds. The Act has repealed this phase-out for tax years beginning in 2018. The deduction for state, local, and foreign property taxes and income taxes remains in place, as well as the option to deduct state and local sales taxes instead of state and local income taxes in any year, but the amount will be limited to $10,000 per year, $5,000 if married filing separate. A 2017 deduction for prepaying 2018 income taxes is specifically disallowed, and such prepayment in 2017 will be considered a payment made in 2018. However, this restriction did not refer to state and local property taxes. The IRS subsequently issued guidance that clarified that only those prepaid real estate taxes that were actually assessed prior to 2018 will be allowed. As you collect your tax information, please remember to not only include what real estate taxes were paid, but also provide documentation or at least affirm that such taxes had been assessed. The deduction for home mortgage interest has changed. Under the old law, we have been able to deduct mortgage interest expense on up to $1 million of our original acquisition indebtedness. Original acquisition indebtedness is debt incurred in acquiring, constructing, or substantially improving a qualified residence, and which is secured by that residence. Refinance debt remains acquisition indebtedness to the extent that it does not exceed the original principal amount of the debt. In addition, under old rules, we could deduct the interest on up to $100,000 of home equity indebtedness, regardless of the use of the funds, so long as the debt was secured by that residence. Under the new law, the maximum amount that may be treated as acquisition indebtedness is reduced to $750,000 for any debt incurred after December 15, 2017. The $1 million threshold remains in place for any debt incurred prior to that date. Also, under the new law, the deduction for home equity indebtedness is repealed.
Amy, we've had a number of questions surrounding the change to the home mortgage interest and its deductibility. Could you provide some examples to help clarify these changes?
Sure. Let's say, for example, we have a married couple with acquisition indebtedness totaling $800,000 that was taken out after 12/15/2017. And let's assume we're talking about two properties, the taxpayer's personal residence and their second home. Interest expense generated on the first $750,000 of the balance will be deductible. Again, for loans taken out prior to 12/15/2017, the old $1 million limit will remain. Now let's change things around a bit. Let's assume the same married couple has acquisition indebtedness of $600,000 between their two properties. They also have a home equity line of credit in the amount of $100,000. Assuming they use the $100,000 to make improvements to their primary residence, this couple would be able to deduct interest on the entire balance of debt, or $700,000. On the contrary, if the line of credit monies was used for something other than improvements to their primary residence, the interest on that line of credit debt of $100,000 would not be deductible. The deduction for medical expenses has changed. The threshold to claim an itemized deduction for unreimbursed expenses paid for medical care of the taxpayer and/or their dependents is reduced back to 7.5% from 10% of adjusted gross income for all taxpayers for tax years beginning after December 31st, 2016 and before January 1st, 2019. This means that the reduced threshold is retroactive and is available for expenses incurred in 2017 and 18. The deduction for charitable contribution deductions has changed. The income-based percentage limit is temporarily increased from 50% to 60% for cash charitable contributions to public charities, private foundations, and certain government units. Taxpayers may still carry forward for 5 years any amounts exceeding the deductible limit in the year of the donation.
Amy, can you talk about some planning opportunities surrounding charitable giving in light of the new tax law?
Sure. Taxpayers across all levels of income may not find themselves exceeding the new standard deductions. This is due to new limits and exclusions on deductions that qualify for itemizing. Planning opportunities arise as taxpayers plan their charitable giving. Let me explain with an example. A married couple is limited to $10,000 for real estate and state and local taxes. Let's assume they have a deductible mortgage interest of $7,000. Let's also assume that they typically give $5,000 a year to charity. Their total itemized deductions prior to charitable planning is $22,000. They will use the $24,000 standard deduction on their tax return and not receive any tax benefit for their donations. A planning opportunity arises as taxpayers consider their giving. For instance, the option of opening a donor-advised fund should be considered. The couple could contribute 5 years' worth of donations, or a total of $25,000 in the current year, allowing them a deduction and bumping their itemized deductions above the $24,000 standard deduction. Then, in the following years, they would take advantage of the standard deduction while the donor-advised fund distributes to the charities of their choice over the next 5 years. This strategy would allow them to optimize their tax benefit for giving while remaining consistent with their gifts. The Act temporarily suspended for tax years beginning after 12/31/17 and ending January 1st, 2026, most itemized deductions that are subject to the 2% of adjusted gross income floor. We've included some examples on the slide, but the big ones that many of our clients have been asking about or have typically seen a benefit on their return include the deduction for investment fees and expenses, the deduction for unreimbursed job expenses, the deduction for tax prep fees, and the deduction for work-related education expenses. Now I'm going to talk a little bit about some adjustments to gross income and the changes. Both the deduction of qualified alimony and separate maintenance payments by a payer and the inclusion of that payment in gross income by the payee have been repealed. However, the repeal is only effective for any divorce or separation agreement executed after December 31st, 2018. Or modified after that date so long as the modification specifically provides that the new provisions should apply. So for any agreements Currently in place, the payer still gets the deduction and the payee declares the income. You might think this would be a revenue wash. However, typically, the tax economic benefit is more valuable to the payor, who is normally the spouse in the higher tax bracket, making this a net revenue raiser to the government. The moving expense deduction has changed. The deduction for moving expenses is repealed for tax years 2018 through 2025. However, the special rule allowing this deduction to members of the armed forces continues to apply. Along with this is the separate provision in the Act disallowing the exclusion for qualified moving expense reimbursements, thus making all such payments subject to both income and employment tax. Some other provisions worth noting: distributions from qualified tuition plans or programs. Qualified tuition plans are modified to allow for distributions to be made for public, private, or religious elementary and secondary tuition. Distributions for elementary or secondary tuition are limited to no more than $10,000 incurred during the year in connection with the designated beneficiary. This limitation applies on a per student, not a per account basis. So if an individual is a designated beneficiary of multiple accounts, a maximum of $10,000 in distributions will be free of income tax, regardless of whether the funds are distributed from multiple accounts. Any distribution in excess of $10,000 would be subject to tax. Existing 529 savings plans can now be rolled into what is known as a 529 ABLE account. These accounts were first introduced in 2014 to help Americans living with disabilities save for education and other living expenses. ABLE accounts offer tax-free growth and tax-free withdrawals when the funds are used to pay for qualified expenses. For ABLE accounts, the allowable expenses are broad and include college, job training, health care, and financial management for beneficiaries with a disability.
Amy, is there a limit to the amount of distribution a taxpayer can take for qualified education expenses in a given year?
The answer is no, as long as the expenses are qualified education expenses for post-secondary education, the distributions are tax-free. Also, if you have a beneficiary with special needs, expenses for special needs services in the case of special needs beneficiary, which are incurred in connection with the enrollment or attendance in a college, will qualify as a qualified education expense. The next subject we will touch upon is the deferral election for stock options. Rick, I'm going to ask you to talk a little bit about this new treatment of qualified equity grants.
Thank you, Amy. Effective for stock attributable to options exercised or restricted stock units settled after 12/31/17, subject to a transition rule. A qualified employee of a privately held company may elect to defer, including in his or her income, the amount of income attributable to the qualified stock transfer to the employee by the employer. The election to defer income inclusion for qualified stock must be made no later than 30 days after the first date the employee's right to the stock is substantially vested or is transferable, whichever occurs first. This also assumes that no 83B election has been filed. If an employee makes the election, the employer's deduction is deferred until the year the amount is included in the employee's income. Detailed employer notices, withholdings, and reporting requirements and qualifications apply. We won't get into that kind of detail today, but nonetheless, it's a great planning tool.
Great, thank you. John is going to talk about some of the changes associated with business losses, but quickly I wanted to mention how they will affect individuals. Excess business losses of non-corporate taxpayers are not allowed for any tax years beginning after December 31st, 2017 and before January 1st, 2026. An excess business loss is the excess, if any, of the taxpayer's aggregate deductions for the tax year from the taxpayer's trade or business over the sum of the taxpayer's aggregate gross income or gain for the tax year from such trade or business, plus $250,000 for single taxpayers and $500,000 for those married filing jointly. I think an example here will help clarify. So for 2018, a single taxpayer has $1 million of gross income and $1.4 million of deductions from a retail business that is not a passive activity. His excess business loss is $150,000, which is the $1.4 million of deductions less the $1 million of gross income plus the $250,000 threshold for a single taxpayer. The taxpayer must treat his excess business loss of $150,000 as an NOL carryover to 2019. NOLs arising in a tax year ending after 2017 are generally not allowed to be carried back, but only carried forward indefinitely. Also, an NOL arising in a tax year beginning after 2017 is limited to the lesser of the carryover amounts or 80% of the taxable income in a carry-forward tax year. To finish up my portion, I'm going to touch on the changes occurring as they relate to estate and gift taxes. The new act doubles the estate and gift tax exemption amount to $11.2 million beginning in 2018, which means that a married couple will now be able to shield $22.4 million from estate taxes.
Amy, does the step-up in basis for gift and GST exemption apply?
The answer is yes, and with the new higher exemption, it may be more beneficial to now focus on obtaining a step-up in basis for highly appreciated assets rather than focusing on transferring such assets to trusts that would shield them from estate tax while foregoing a step-up in basis. It is very important to reach out to your advisors and review estate plans to determine if any changes are warranted. Irrevocable life insurance trusts for the purpose of funding for estate tax that was anticipated at death should also be reviewed. With the aforementioned changes, does it make sense to maintain such life insurance? Again, a review of estate plans in light of the new rules is essential. Finally, I just want to mention the changes affecting trusts. As you know, estates and trusts have been subject to highly compressed tax brackets, and that has not changed. But the applicable rates are generally reduced through 2025. We've included a slide for your reference. The current 15% rate will drop to 10%, the 25% and 28% brackets go to 24%, the current 33% bracket actually increases to 35%, and the maximum 39.6 bracket is reduced to 37%. The taxes on capital gains and qualified dividends will be slightly better than under prior law, with a new 0% bracket break point at $2,550 and 15% capital gain break point to be at $12,501. For taxable income in excess of these limits, capital gains and qualified dividends will be taxed at 20% for estates and trusts. It will continue to make sense to consider making distributions to carry distributable net income to individual beneficiaries with much more favorable brackets. These changes apply from 2018 through 2025. As mentioned earlier, individual exemptions were repealed by tax reform. The modest exemptions available to estates and trusts under current law will remain under the new law. In addition, the alternative minimum tax, its current exemption phase-out amounts, will continue at the same levels. Now, John Parker will talk about the many changes we'll see on the corporate side.
Thank you, Amy, and thank you again for everybody for joining us today. Under the Tax Cuts and Jobs Act, the tax rate for C corporations has been reduced to a flat 21%, and the corporate level AMT has been repealed. The dividends received deduction for C corporations has been reduced from 80 and 70% to 65 and 50% respectively. Under old law, generally a corporation is allowed a deduction for dividends received from other taxable domestic corporations. Historically, this has been 70% of the dividend received, or 80% if the dividend is received from a corporation that the taxpayer owns 20% or more of. Further, in the case of a dividend received from a corporation that is a member of the same affiliated group, the deduction is equal to 100% of the dividend received. Under the new law, the 100% remains in place for members of the same affiliated group, but the 80 becomes the 65 and the 70 becomes 50. The new law retains certain limitations for qualifying for the deduction, such as minimum holding period and among others. One of the biggest areas for owners of pass-throughs is the new qualified business income deduction. As we just noted, the corporation income tax rate has been reduced to 21%, but income from flow-through entities, however, is still subject to the income tax rates of their individual owners. The new tax rates and the qualified business income deduction are intended to alleviate some of the tax gap between these different business structures. Individual taxpayers are allowed to take up to a 20% deduction of certain qualified business income from a partnership, S corporation, or a sole proprietorship. For example, an individual taxpayer with $1 million of qualified business income might get a deduction of $200,000. Owners of certain specified service trades or businesses may not be entitled to this deduction at all, though. Specified service businesses include areas such as health, law, accounting, actuarial services, performing arts, consulting, athletics, financial services, and brokerage services. Important to note is engineering and architectural service businesses are excluded from this category, so those activities will qualify for the new deduction, subject to the other limitations we'll talk about. There is a provision in the law that also includes in the definition of specified service trades or businesses that are dependent on the reputation or skill of one or more employees. And we'll need some guidance from the Internal Revenue Service and notices or regulations on how that provision is going to be implemented. So if the owner's taxable income on their 1040 is between $157,500 and $207,500 for single filers, or $315,000 and $415,000 for joint filers, then a partial deduction for the qualified business income will be available. And these phase-out thresholds will be indexed for inflation each year. Qualified business income is the net amount of the business's qualified items of income, gain, less deductions and losses, to the extent that they are effectively connected with the conduct of a trade or business within the United States. For individuals that have more than one source of qualified business income, all of the qualified business income activities are added together to determine the total amount that each taxpayer will be allowed for the qualified business income deduction. A qualified trade or business's deductible amount is generally the greater of 50% of W-2 wages paid by the business allocated to the individual owner, or the sum of 25% of those W-2 wages allocated to the owner, plus 2.5% of the unadjusted depreciable basis of certain business property. These two limitations, wage limits, do not apply if the taxpayer's taxable income is less than the $157,500 if single, or the $315,000 if married filing jointly. If the net amount of the qualified business income is less than zero, the loss is carried over to the next year, and any deduction allowed in the following year is then reduced, but not below zero, by 20% of the carryover qualified business income loss. This qualified business income deduction is effective for taxable years beginning after December 31st, 2017, and the deduction will not apply for taxable years beginning after December 31st, 2025. So we've got the deduction for 8 years. In the area of like-kind exchanges are only going to be allowed for exchanges of real property that is not primarily held for sale after 2017. Like-kind exchanges will no longer be allowed for depreciable tangible property. A common item many of our clients have used for like-kind exchanges in the past for non-recognition treatment is on the trade-ins of cars or trucks or machinery and equipment. As an example, under the new law, a business trading in a fully depreciated old car for a new car would have to recognize and pay taxes on any gain on the trade-in. For example, if the new car is worth $60,000 and you pay $50,000 plus the trade-in, assuming the old car is fully depreciated, there will be a $10,000 gain on that disposal of the older car. And the new car will have a depreciable basis of $60,000. Under the old law, using the same facts, the $10,000 gain would have been deferred, resulting in the new car having a depreciable basis of the $50,000. In the area of depreciation and depreciation-related deductions, the Section 179 limitation has increased to $1 million, and the investment limitation phase-out related to 179 has been increased to $2.5 million, beginning with tax years after 2017. Qualified real property eligible to be expensed under Section 179 now includes improvements to the interior of any non-residential real property, or referred to as qualified improvement property, roofs, heating, ventilation, and air conditioning property, fire protection, alarm systems, and security systems installed on such property. Section 179 does retain the $25,000 cap on the deduction claimed on an SUV, and an SUV still has the definition of gross vehicle weight rating between 16,000 and 14,000 pounds. Bonus depreciation, separate from 179, has been extended and increased to 100% bonus depreciation for property acquired and placed in service after September 27th, 2017, and before January 1st, 2023. As you can see on the slide, the bonus depreciation percentages will begin to be reduced for tax years beginning on or after January 1st, 2023. It's also no longer required for property to be new in order to be eligible for the 100% bonus, thus allowing bonus depreciation on used property for the first time. Used property that is eligible for the 100% bonus is eligible property acquired for the first time by the taxpayer and that is not acquired from a related party. The listed property Section 280F limitations for passenger automobiles have been amended, increasing the annual depreciation limits on those passenger autos. We're now allowed, starting in 2018, $10,000 of depreciation deduction in the first year, $16,000 in the second year, $9,600 in the third year, and then $5,760 for each remaining year until the passenger auto is fully depreciated. And you can see on the slide the amounts in parentheses that are effective for tax year 2017. And you can see that we've had a substantial increase for 2018 in this area. The maximum first-year bonus depreciation allowance on luxury autos remains at $8,000. So the total first-year depreciation would be the $10,000 regular depreciation limit plus the $8,000 bonus depreciation to get us to $18,000. Some other provisions impacting other business deductions. First, in the area of the deduction for entertainment and commuting benefits and meals. There is no longer any deduction allowed for entertainment, amusement, or recreation, club membership dues, or a facility used in connection with any of the above. These expenses are now subject to 100% disallowance instead of the 50% disallowance as in the past. No deduction is going to be allowed starting in 2018 for expenses associated with providing qualified transportation fringe benefits to employees, and except for certain safety concerns, any commuting expenses incurred as well. Taxpayers may still deduct 50% of the food and beverage expenses associated with operating their trade or business, meaning meals consumed while traveling for work. In addition, the new law expands the 50% limit to include expenses of the employer associated with providing food and beverages to employees through an eating facility that meets the requirements for the de minimis fringe benefit rules or meals provided for the convenience of employer. For net operating losses, Amy already touched on the individual changes, but for corporations, net operating losses arising in tax years beginning after 2017 may only be used to reduce 80% of the corporation's taxable income in the future in each specific year. The 2-year carryback period is eliminated, and although NOLs may now be carried forward indefinitely. And lastly here, the domestic production activities deduction, or the DPAD deduction, is repealed for tax years beginning after December 31st, 2017. One of the biggest areas of business limitations for deductions is in the area of the business interest limitation. The deduction for business interest will now be limited to 30% of the adjusted taxable income of the taxpayer for that taxable year. Business interest is any interest paid or accrued on indebtedness properly allocable to a trade or business. And adjusted taxable income does not include any item of income, gain, deduction, or loss that is not properly allocable to a trade or business. So if there's multiple trades or businesses within the same corporation, each separate trade or business will have its own business interest expense limitation calculation. Adjusted taxable income also does not include the deduction for business interest or does not include any business interest income. The amount of any net operating loss deductions or any deduction under Section 199 capital A with respect to the qualified business income of a pass-through entity, which is the 20% deduction we discussed earlier. An exception to the limitation on the business interest deduction is the limitation for tax years with average annual gross receipts for the 3 tax year period ending with the prior tax year that does not exceed $25 million. So for the 2018 tax year, the 3-year average gross receipts test is the average gross receipts for the 2015, 16, and 17 years. Another exception for this is if your business engages in the leasing, construction, development, acquisition, operation, management, or brokerage of real property, those businesses can elect to opt out of the 30% interest expense limitation. However, if they do so, then those businesses must depreciate the residential and non-residential real property as well as qualified improvement property to those buildings using the alternative depreciation system method. Therefore, they would not be eligible for the 100% bonus depreciation on the qualified improvement property since those assets will be depreciated under ADS. The amount of any business interest that is not allowed in any taxable year is treated as business interest paid or accrued in the following tax years. Suspended interest deductions may be carried forward indefinitely. In the area of business tax credits, a couple of noteworthy items. There is a new tax credit for employer credit for paid family and medical leave. The tax credit is available for paid leave provided under the Family and Medical Leave Act after 2017. An eligible employer is allowed the Family Medical Leave Act credit if in an amount equal to the applicable percentage of the wages paid during the leave. The applicable percentage is 12.5%, increased by 0.25 percentage points for each percent that the rate of pay exceeds 50% of normal wages. And for the rehabilitation credit is now limited to 20% of the qualified rehabilitation expenditures of the taxpayer that is claimed ratably over a 5-year period, beginning in which the rehabbed building is placed in service. In order to qualify, the building must be a certified historic structure and the expenditure must be in connection with a certified rehabilitation project. There's some changes in accounting methods that are allowed to be used for small businesses. The cash method of accounting and other simpler accounting methods have been made available to more taxpayers. A single 25 million gross receipts test has been put in place to determine whether certain taxpayers qualify as small taxpayers that can use the cash method of accounting, that may not be required to use inventory accounting, they may not be required to apply the uniform capitalization rules, and they may not be required to use the percentage of completion method for small construction contracts. That doesn't mean that a small business that has inventories can just expense everything, though. Inventories for these taxpayers will be treated as non-incidental materials and supplies under the tangible property regulations that came into effect after the 2014 tax year. They still go on the balance sheet, and they have to be counted at least at the end of the year. Two special rules have been added on the proper timing for including amounts in income by accrual method taxpayers related to certain advance payments that they receive. Under the first rule, amounts are generally included in income no later than when the amounts are included for financial accounting purposes. The second rule allows taxpayers to elect to defer including certain advance payments in taxable income until the tax year after the tax year in which the advance payments were received, and that's subject to certain limitations as well. In the area of S corporation conversions to C corporations, any Section 481 adjustment resulting from an accounting method change that is attributable to an eligible S corporation's revocation of its S election during the 2-year period beginning on December 22nd, 2017, will be taken into account ratably over a 6-year period beginning with the year of change. The normal default rules for accounting method changes are income would be brought in over a 4-year period, so there's 2 extra years in this provision. An eligible terminated S corporation is any C corporation which was an S corporation on the day before December 22nd, 2017, which during the 2-year period beginning on December 22nd, 2017 makes a revocation of its S election, and the owners of the stock determined on the date of the revocation are the same owners and in identical proportions as on December 22nd, 2017. If an eligible terminated S corporation distributes money during the post-termination transition period, which is the 2-year period after the revocation of the S election, the accumulated adjustments account, or AAA, will be allocated to such distribution, and the distribution will be chargeable to accumulated earnings and profits in the same ratio as the AAA bears to the amount of accumulated earnings and profits. Under old rules, the new C Corp was allowed to distribute the S Corp AAA during the post-termination transition period first without causing a taxable dividend from accumulated earnings and profits. The new rule now has the distribution during the post-termination transition period coming out ratably out of AAA and A&P, so there's partial taxability here.
Thank you, John. We do have time to answer a few questions, and with that, I'd like to turn it over to Rick.
Thank you, Sarah. Question is, should my S corporation change back to a C corporation now that the C corporation tax rates are much lower than individual tax rates?
So the quick answer to that question is there is no quick answer to that question. The facts and circumstances of each corporation will need to be looked at to make a determination of whether this would make sense. However, it's important to note some factors to be considered is that C corporations are still subject to 2 levels of taxation. First, at the corporation level, the corporation's taxable income is taxed at 21%, and then the owners are taxed on the dividends at presumably the qualified dividend rates of 15 or 20%, depending on the owner's taxable income. Also, if the owner's taxable income rises to the level to where the individual owners are subject to the net investment income tax, the dividends would also be taxed at an additional 3.8% federal tax. Many corporation owners would say that they would just retain these profits in the corporation and not pay out the dividends for as long as possible. But C corporations need to be aware of the accumulated earnings tax, which is a surtax at the corporate level of 20% of the excess accumulated earnings or retained profits. The biggest issue here is that the rules surrounding the accumulated earnings tax are highly subjective, and when the IRS invokes this tax, which it usually does upon audit, there is almost always a costly legal argument to defend against this tax. So it would be important for any C corporation in this situation to make sure to document each year what the reasons for a growing retained profits would be. And that could be planned expansion, planned additional R&D for new products coming out, a planned acquisition of a new company, and things like that. But it would be much better to have these items documented on an annual basis and be ready to defend upon audit the invoking of the accumulated earnings tax from the IRS. Also, for S corporations that are thinking of going back to C corporations, if there are any designs on a potential sale of the company, that is where the savings of the single level of taxation for an S corporation will have the biggest impact. And that's the key point that's going to need to be addressed in any decision to be made in this area.
John, when does that election have to be made for an S Corp to terminate its election and become a C Corp?
The election to terminate for an S corporation has to be filed with the IRS no later than the 15th day of the third month into the tax year of the change. So for a change for 2018 for a calendar year corporation to be effective on January 1st, 2018, that election statement must be filed on or before March 15th, 2018. If it's filed after this date in 2018, the termination would take effect at that point, and we'd have a stub period S corporation return and a stub period C corporation return.
There's been a lot of talk around deferred exchanges. What happens if there's an open deferred exchange at 12/31/17?
So that's a common area around the like-kind exchange rules where you can have a deferred exchange, so you could buy your replacement property first and then sell the property you're giving up at a later date within certain date ranges. There is a transition rule that's included in the new law if a taxpayer has either disposed of the relinquished property or acquired the replacement property before December 31st, 2017.
Great. Thanks so much, John, and thank you to everyone for joining us today. As I mentioned, if we didn't get to your question, we will follow up with you after the webinar. We're also going to be emailing you a link of a recording of today's webinar for your reference or to share with others. Thanks again, and we hope to host you on another webinar in the future. Enjoy the rest of your day.